Have you ever caught yourself daydreaming about a home like this or this? Well, stop dreaming, because in today's video, we're breaking down exactly how much income you'll need to buy or rent a home at different price points, especially with today's sky-high prices and current interest rates. Hi, I'm Sean Black, co-founder and CEO of Knock.com, which helps you buy your new home before you list or sell your current one. I was also part of the founding team at Trulia.com, which eventually sold to Zillow for $3.5 billion. So I've got plenty of experience to share about what you can really expect from both sides of the housing equation. Renting versus buying. First things first, the monthly cost for renting and owning aren't created equal. In fact, they can be wildly different, and a lot of people underestimate just how much extra responsibility comes with owning a home. Renting is straightforward. You pay a set amount each month, and that's it. No unexpected repair expenses you didn't see coming. Hence the old saying, your rent is the most you'll ever pay each month. Your mortgage is the least you'll ever pay each month. On the flip side, owning a home brings a whole checklist of other costs. First, mortgage and your mortgage payment. Principal and interest, usually amortized over 15 or 30 years. Then you have property taxes. These can be anywhere from 0.4% to 2% of the home's value annually, and they tend to increase as property values go up. Insurance, your lenders will require a comprehensive policy to protect against everything from natural disasters to a runaway car landing in your living room. Then you have repairs and maintenance, everything from your HVAC system to termites. One popular rule of thumb is 1% of the home's value each year for repairs, or 1% per square foot. Then you have other miscellaneous fees like HOA fees, landscaping, periodic upgrades, cleaning, basically all the little and not so little costs that pop up with home ownership. Because of all this, buying tends to cost a lot more per month than renting. So it's crucial to think carefully about which route works best for you. Let's look at how much you should spend on rent versus what you should spend when buying a home. First, how much should you spend on rent? There's a classic guideline that says you shouldn't spend more than 30% of your gross income on rent. So if you make $40,000 a year, that's $1,000 a month. If you make $80,000 a year, that's $2,000 a month. And if you make $160,000 a year, that's $4,000 a month. But that 30% rule dates back to 1969, long before we had student loan debts, $700 car payments, and in-app purchases that drain your wallet. For a more modern approach, consider the 50-30-20 rule. 50% of your take-home pay after taxes for essentials like housing, food, and transportation, 30% for things you want, clothes, travel, hobbies, etc., 20% for savings and debt repayment. That helps keep your budget balanced and forces you to consider other obligations. In some places though, like parts of New York, people are spending closer to 70% on housing, which can be tough to sustain. Another approach is backward budgeting. List out every monthly expense you must pay, food, insurance, debt payments, etc. Factor in 15 to 20% for savings, throw another 10% at discretionary spending, and then whatever's left is your housing budget. This automatically makes sure you're saving before you decide what you can afford in rent. How much should you spend when buying a home? When it comes to buying a home, the rules of thumb get even more complicated. One popular rule is the 28% rule. This states that you shouldn't spend more than 28% of your gross monthly income on your mortgage payment, including taxes and insurance. So if you make $5,000 a month, that's $60,000 a year, 28% of that is $1,400 a month. With today's rates, that might only afford you a home in the $215,000 range, assuming a 20% down payment and the current 6.5% interest rate. Compare that to when rates were 3%, and suddenly $60,000 a year could have bought you a $315,000 home. Big difference. Under the same 28% rule, you would need $138,000 to swing a $500,000 home, a $212,000 annual income for a $750,000 home, or a $276,000 annual income for a $1 million home. But if you talk to most lenders, they'll often approve you for more. So keep that in mind, but don't stretch yourself too thin. Then there's the 30-33 rule. This is a common guideline. It has 3 parts. No more than 30% of your gross income goes towards housing costs, including principal, interest, taxes, and insurance. Have at least 30% of the home's value saved in cash or liquid assets, enough for a 20% down payment plus 10% reserve for emergencies. Don't buy a home priced higher than 3 times your annual income. So if you earn $75,000 a year, your limit should be a $225,000 house. If you earn $150,000, that's a $450,000 house, and so on. Now, if you're on the West Coast, 3 times your annual income might be impossible for a home purchase, but in many parts of the country, it's still a useful conservative benchmark. Okay, so what do lenders actually look for? If you're going the traditional mortgage route, lenders usually focus on a few things. First, stable income. They're going to ask you for 1 to 2 years of tax returns. Then debt. The big one specifically is your debt to income ratio, or DTI. Most want it under 45%, meaning less than 45% of your gross monthly income is spent on all debts, including your new mortgage. So if you make $8,000 a month and your total debts, student loans, car payments, credit cards, etc., are $1,300, you can spend up to $2,300 a month on a mortgage. That might get you a $350,000 home with a 20% down payment. If you have zero other debts, you could push that up to $3,600 a month, which might afford you a $550,000 home. Whether that's a smart move is another question. For some quick reference, an $800,000 home might need a $12,000 a month income. A $1.2 million home might need an $18,000 income, and a $2 million home, $30,000 a month in income or more. These figures assume a good credit, 20% down, and meeting that sub 45% DTI. Okay, let's wrap up with 3 of my top suggestions. First, compare renting versus buying carefully. In most metro areas, renting is currently cheaper than buying, sometimes by as much as 25%, according to Redfin. So you could be saving money by renting for now, especially in the short term. Meanwhile, you can wait for a good deal to pop up. I'm all in for owning when you plan to keep the property for a decade or more, or when you find a fantastic deal that you can't pass up. Second, use a buy versus rent calculator. The New York Times has a phenomenal calculator that factors in everything from taxes to opportunity cost of tying up your down payment. Plug in the numbers and it'll give you a realistic picture of whether buying or renting makes the most financial sense for you. Finally, shop around and negotiate. If you decide to buy, get quotes from multiple reputable lenders to secure the best interest rate, but also get the best lender, because it'll make a big difference. Negotiate with the seller, and don't be afraid of minor cosmetic work if it helps you score a better purchase price. Above all, stick to what you can afford comfortably. Nobody wants to be house rich and cash poor. That's it for today, guys. I hope this helped clarify exactly how much you should budget for rent, what lenders expect when you're trying to buy, and how to figure out the right move for you. If you found this video helpful and would like more tips and tricks, please hit the like button, subscribe if you haven't already, and share this with a friend who might be on the fence about buying a home. Thanks so much. Until next time, happy house hunting.